Hi everyone. So in this session we will be learning about what is a preference dividend coverage ratio. Okay, preference dividend coverage ratio. So it is one of the coverage ratio. As I explained earlier, coverage ratio will reflect the long-term solvency of the organization. Okay, so in that you have preference dividend coverage ratio. Okay, so let us understand what is a preference share first. Okay, so preference shareholders are also the owners of the company. It is neither a debt fund not a equity. Okay, so but when say if the company, a particular company is dissolved, then what happens? The whatever assets are sold and whatever amount is received, the first whenever there is a repayment, the first priority is given to your debt, that is your secured loans, debentures. Okay, then second priority is given to your preference shareholders, and the third is, at last, it is equity shareholders. If something is remaining, that is being shared among equity shareholders. So usually preference shareholders will have a fixed dividend. Okay, fixed dividend which is to be paid every year. Okay, now there are two things in preference shareholders also. So preference shareholders, for example, you may have 8% preference shares. Okay, say you have 60,000 preference 8% preference share at rupees 10 each. Okay, so your share capital is how much? 6 lakh. Okay, so in this also there may be a two types. One is cumulative preference shares and other one is non-cumulative preference shares. Okay, so since these are preference shareholders, they are owners, so the share, that is dividend, is paid to them only if there is a profit. Okay, so what do you mean by a cumulative preference share? Suppose in year 1 there is no profit. Okay, so no dividend is paid. Same here, year 1, suppose there is no profit, so no dividend is paid. Okay, then year 2, okay, suppose there is a profit, sufficient profit to pay the dividend, then in case of cumulative preference shares, the dividend is paid for 2 years, that is year 1 and year 2. Okay, whereas in non-cumulative preference share, dividend is paid only for that particular year whenever there is a profit. Okay, so if you see, the nature of preference share is something between the equity share and the debentures. Okay, so whenever there is a profit, there is a fixed liability to pay your preference shares dividend at the fixed rate, whatever is given. So we need to find out preference share holders coverage ratio. Since there is a fixed liability which is required to be paid to the preference shareholders, even if you have cumulative preference shares or you have non-cumulative preference shares, whenever there is a profit, you have to pay the dividend if there is a sufficient profit. If there is no sufficient profit, in case of cumulative preference share, you need not pay any dividend, but whenever there is a profit, you have to pay a cumulative dividend of all the previous years also. Whereas in non-cumulative preference shares, no profit, no dividend, but if there is a profit, you need to pay the dividend. So it's a fixed liability. So in above case, if you see, 6 lakhs is the share capital. So per year dividend, 8% of 6 lakh, 48,000, right? So for cumulative preference share in year 2, you will have to pay 48,000 of year 1 plus 48,000 of year 2, right? So that comes to how much? 96,000. Whereas in case of non-cumulative, you have to pay dividend of 48,000 in year 2. Okay, so this is how you calculate your preference share, the dividend. Right, now we will see how do we calculate preference dividend coverage ratio. So now preference dividend coverage ratio is equal to earning after tax divided by your preference dividend liability. Okay, so what does it means? Preference dividend coverage ratio is earning after tax divided by preference dividend liability. Okay, so earning after tax is what? Your profit after tax. Okay, so that is before sharing or before appropriation. So before distribution of profit to your equity shareholders and preference shareholders, you have to consider that profit and then divided by your preference dividend liability. So what does it show? It shows how many times is your profit after tax over your preference dividend liability. So is the profit after tax sufficient, or is it able to cover your preference dividend liability? This is what is shown in the preference dividend coverage ratio. Now earning after tax is considered because unlike debt on which interest is charged on the profit of the firm, the preference dividend is treated as appropriation of profit or distribution of profit. So what happens is, unlike your dividend wherein the interest expense is an allowable expense for your income tax, whereas preference dividend is not an allowable expense for your income tax purpose. That is why we are considering profit after tax. Okay, so this ratio in short indicates margin of safety which is available to the preference shareholders, and similar to your debt coverage ratio, okay, or debt interest coverage ratio, a higher ratio is desirable from preference shares point of view. Okay, shareholders point of view. Now we'll see one example on how to calculate this preference dividend coverage ratio. So in the books of XYZ, okay, profit and loss account is given for the year ended 31st March 2017. Okay, so you have a credit side and the debit side. So on credit side, we have a gross profit after charging depreciation of 1 lakh, that comes to 12,50,000. Then by income of investment 50,000, and miscellaneous income is 2,000. So total comes to 13,02,000. Then on debit side we have expenses, administrative expenses 3 lakh, selling and distribution expenses 1 lakh, to interest 50,000, to loss on sale of fixed assets 12,000, to goodwill return of 15,000, to preference dividend 2 lakh, to tax provision 4,12,000, and to net profit. Okay, so that is nothing but net profit after tax, and so that comes to 2,13,000. Okay, so now we have to calculate how it is a preference dividend coverage ratio. Okay, so preference dividend coverage ratio, so that is nothing but earning after tax divided by preference dividend liability. Now earning after tax, what is the earning after tax? Now net profit given is 2,13,000. Now the 2,13,000 is after tax as well as after distribution of your preference dividend. Okay, so we need to find out earning after tax but before appropriation, that is before distribution of preference dividend. So earning after tax will be 2,13,000 plus preference dividend, that is 2 lakh, divide by your preference dividend liability, that is 2 lakh. So it comes to 4,13,000 divide by 2 lakh. So that comes to 2.065. So that means, so your earning after tax but before appropriation is 2.065 times of your preference dividend liability. Now that means it is able to sufficiently cover your preference dividend liability for the year. Okay, so 2.065 indicates a higher ratio, right? And the higher ratio is desirable from the preference shares point of view. Okay, now since the preference shareholders are the owners of the company, you see, if you see this preference dividend coverage ratio, we have taken earning after tax. Okay, so we have considered all the expenses, whether the expenses are operating expenses, non-operating expenses, cash expenses, depreciation, everything is considered. Now, why that is considered is, see, preference dividend liability, okay, they are your shareholders, they are your owners of the company, correct? So owners of the company are subject to dividend only if there is a profit in the company after covering all types of expenses, that is your cash expenses, non-cash expenses, your operating expenses, your non-operating expenses also. So that is the reason while calculating a preference dividend coverage ratio, what we have taken is earning after tax. So we are considering all types of expenses here, whether it's a non-operating expense or a operating expense. Okay, so this was about a preference dividend coverage ratio. Okay, thank you.